people were letting in. Tonight, what we're going to focus on is the valuation model that you guys were starting to build. And in case anybody had trouble with the model, I just posted a file to the announcements in the Elm site with a solution file, just so you have that if you need it. Obviously, if you created it, you shouldn't need it, but regardless, I want to make sure everybody has that file as we kind of go forward. So what I'm hoping that we'll do tonight is we'll finish talking about the Walmart valuation, and then we'll try and do Nike in class tonight, and then set you up for your next homework assignment, which I'm changing a little bit so that you can actually just use this model to do another valuation for next week. So just kind of continued practice on this, because this is also the model you're going to be using for your group projects. All right, so I want to make sure that we know how to use this reusable model, which can be tied back to Bloomberg. Okay, so we're going to kind of focus on that tonight, on the mechanics of all that. So that's our plan. So let's go ahead and get started. So first of all, I'm going to go ahead and share my screen. Actually, share my desktop just so I can jump back and forth here. But essentially, this is the file that I had uploaded, which basically you should have copied and created, which got you to within 1 penny of the share price of Walmart. Excuse me. And let me just kind of stop here, just see if anybody had any questions or challenges about getting to this stage of the model in your valuation. Was everybody able to successfully get here? Questions about that? Right. So what you basically did as part of this assignment is you created the concept of what we're going to call, again, an as-is model. And the idea is we're valuing the company at its current share price. The standard that I like to use, just my rule of thumb, is within $1 of the current share price, we got within a penny, right? And that's basically a way of saying we're working backwards. We know the price. These are the assumptions that help us justify that price, okay? So that's kind of the first step in the valuation. Right? So we have our as-is model, right? What we want to do next with this model is create 3 more prices as part of our valuation. Okay. The next model we're going to create is going to be called the bull, and then the one after that's called the bear. And what we're establishing is a range for the company. Okay. So increasingly on Wall Street, we're not just asked to give a price target of the company. We're asked to give a range. I want to know not just what you think the company's going to trade at. I want to know my upside. I want to know my downside when I put my portfolio money to work. So increasingly, analysts are not just giving a target share price. They're helping people understand the risk of the company they're investing in by giving the range. And then we don't want the range to be just arbitrary, right? We want to actually create a reasonable range for whatever stock that we are valuing it. So we don't just say plus or minus 10%. That's not very helpful, right? And it might not be a symmetrical range. It might be plus 15, minus 20, right? But I also need to know, like, why? Why are you giving me that range as opposed to you just give me random numbers? So the first part is, how do we create that? And then secondly, how do we make sure that we're doing it in a reasonable way, because we can quickly change the numbers and the valuation that we do. So you're going to need to follow along with me on the next couple of pieces that we're going to do. So if you don't have your model up, get your model up. And if you need a model, grab this model, but have it open. And we're going to keep building it here in class tonight, so you don't have to build it in class. And at the end of class, you can use this to do your next assignment. Otherwise, you're going to have to complete this to do your next assignment outside of class. Now, we are recording this, but regardless, it might be easier if you kind of do this as we do it. So we're going to create a new tab in this model. At the very end, worksheet after the DCF tab.
I'm sorry,
And
Professor.
we're going to call this the multiples tab.
Professor.
Okay. Just a blank sheet, make it a little bit bigger. And what we're going to put here on the multiples tab is going to come from Bloomberg. So again, you might want to be logged into your cloud account. So in this case, go back to Walmart, US equity.
Professor?
And we're going to go to the RV screen. And in RV, these are, I'll use the analyst curated, these are the peers of Walmart. So
excuse me, Professor.
I'm going to go over here to custom, and we're going to create our own template. And specifically the template that we're going to
We should all wave together.
Involves four, what happened?
Can you hear us?
Can you hear us?
I'm seeing some of this. Oh, you can't hear me?
No,
No,
you can't hear us.
I got cut off. All right, hold on. This doesn't sound good. I can't hear you guys either, so that doesn't sound good. Let's see. Stop the share. Mute. Okay. How about that? All right. Somebody say something?
Com check.
There we go. I can finally hear you guys.
All right, sir. So I had a question earlier. You said that you just posted this this model in the announcements.
Yes.
I didn't see it in there.
I thought I posted. All right, let me double check. Let's go back to announcements. I could have sworn I did. Zoom announcements. Huh. I don't know where it is. Let me repost this. All right. Walmart. What's this? No, I don't want to auto save. Walmart. What is this? Files for April 7th. Thought I did. Insert. What is it? Document. Upload document. And the file was the as is. Submit. Save. Thought it was there. Sorry about that. Should be there now. Just renamed it as is one because I'd actually uploaded it before. I don't know why the announcement didn't post. Anyways, that's the file. You would have created this file, or it's your solution file. So back to what I was trying to do with the Excel file, got a new tab in this file called multiples. And this relates to the bull and the bear. And what we're going to do is we're going to use the multiples to create the concept of what we're going to call a sanity check, right? So that when we create the bull, we need to make sure that we create a realistic bull. And we create the bear, we need to create a realistic bear. So we're going to use the multiples to help us do this. Now, this is actually content that is 2 weeks out in the book and in your assignments, but I'm going to kind of preview some of that tonight because it will help us as we build out our model. And the idea is that back to in Finance 101, they used to call this the law of one price. And the idea of the law of one price is that there's one value for the company, and it shouldn't matter how many different ways you value the company, you should still get the same value. It's just pretty much rearrange math when we do different valuation methodologies. So if you do a multiples analysis of a company, you need to get the same share price as if you did a DCF of the company, right? So that's going to help us when we are about to check our DCF by looking at the multiples. So there are 4 multiples that we're going to focus on this semester, and we're going to use those multiples for our sanity check. So right now I'm just going to put them quickly into a template. So back to our Bloomberg template, the 4 multiples that we're going to care about is that basically create a custom template, create the template, and I'm going to add 4 columns. The first one is going to be EV space TO sales. All right. And this is going to be...
We're not seeing your screen.
You can't see my screen?
No.
All right. Try it again. So went to RV in Bloomberg. Actually, went to Walmart first, then went to RV. Using the analyst curated comps, go to custom. And in this space where it says add column, the first multiple we're going to do is the enterprise value to sales or revenue multiple. So you just type in EV space TO space sales. And Bloomberg already has, because they're used by analysts, 2 enterprise value to sales multiples right here. Enterprise value to this year's sales, which is the upcoming forward year, and enterprise value to next year's sales, which is the one we're going to use, which is the next full year. That's forward year 2. So back to EV to sales, we want next year. This is forward year 2. Hit enter. There's actually different ways to create this in Bloomberg, but the idea is this is the industry average, and these are all the companies, including Walmart. Second ratio we're going to do is EV, and you can also do this with a divide by EBITDA. Right? And we want EV to EBITDA, you can also do a 2, for next year. Now there's a lot of EV to EBITDAs. It's not finding in the search, show more matches. Scroll down. And then the match that we're looking for is enterprise value to next year's estimated EBITDA. Right there. You can select it, gives you the definition, hit update, chooses it, populates it. Okay.
Professor, I'm sorry, is this session being recorded right now? I saw you do pause.
Yes, we are recording.
Okay, thank you.
Yes, we are recording. Next is we want an EV to EBIT multiple. So again, EV either TO or divided by EBIT. And again, we want next year estimated EBIT, or this year, sorry, next year estimated EBIT. And then the final one we want is the price to earnings ratio. So you just type in P to E for next year, P/E. And you want the estimated PE for next year. Right? So those are the 4 multiples. And then you want to save this template. Right? Now my template, I'm just going to call multiples. You can call yours whatever you want. And it will basically just put it right here on this menu bar. Now what we've actually done is in the EEO screen, these are the forward years that the analysts are forecasting. And this is forward year 1, forward year 2, actual estimate, forward year 1, 2, forward year 3, forward year 4. This is, in Bloomberg parlance, this year, next year. This year's forward year 1, next year's forward year 2. So here's the idea. Look at PE. This is the price. This is next year's earnings. Price divided by earnings, PE. So we could have actually manually gone through these screens and put them in Excel for every company, 4 ratios by a bunch of companies, and manually created this, right, off of this template. But instead of doing this manually, we're just kind of using the Bloomberg tool to do that with RV. So this is just kind of scrounging through and getting the current second year multiples for enterprise value to sales, enterprise value to EBITDA, enterprise value to EBIT, and PE. Okay? Now, next thing, we're going to want to put this template in our model. So where it says settings in Bloomberg, you need to go to global settings. And 2 things matter. Number 1, it needs to say static data. Okay? So it says Excel export mode. You want to export static data. You don't want to export dynamic links. Okay? So static data. The other thing is when you log into your Bloomberg account in the cloud, you're going to want to log in with the Excel add-in. It's going to be very important going forward. Because you're going to dump data to Excel. You're going to need Excel in the cloud to dump the data to. So again, static data. Close that. All right? And then we're going to export this sheet to Excel. And so what it's going to do is it's going to dump the data into Excel. Make it a little bit bigger, you can see it. And what's important is when you said static data for the export, then these are numbers. All right? if you did dynamic link, these would not be numbers. What these would be are database lookups, which would work when you're in the cloud, but when you left the cloud with this file, it would error out. So that's why you want to make these static numbers, not dynamic numbers. So back to this. I then want to take this. I want to copy this, the file that I just exported, multiples. I want to make this the last tab of my Walmart model, cell A2, paste it. So for Walmart's peers, these are the multiples of all the companies, the range of the universe of these 4 multiples that they're trading at. But I skipped row 1. And I skipped row 1 for a very specific reason. So this is enterprise value to sales multiple. So here's the point. In our model, in the DCF tab, we're calculating an enterprise value. In our model, in the income tab, second forward years, 2023, we have sales, which means in our model, we have an enterprise value to sales multiple that we're forecasting. Okay? And that's what we're about to do. So what we're going to do is we're going to have the model multiple on row 1. This is how we do sanity checks for our model. So over here in cell D1, we're going to put enterprise value to sales multiple. Okay? Except apples and oranges. So this enterprise value comes from Bloomberg, and this enterprise value is Modigliani Miller, and Bloomberg makes adjustments to this enterprise value, so they calculate it slightly differently than the traditional Modigliani Miller view. And to see their calculation, you can go to FA, and right here on the FA screen is the calculation of enterprise value. Because what they're doing is they're taking the value of the equity, the value of the debt, the value of the other preferred and other equity, and they're subtracting out cash. Right? So, translation, what Bloomberg is doing, so in cell E18 on DCF, I'm going to call this the Bloomberg enterprise value, their equivalent, is they're basically saying the same thing we would do for enterprise value. They're taking all this debt and equity, and they're subtracting all the cash. Now, if we were to take enterprise value and subtract cash, what you're primarily left with is operating value. So first thing I want you to start to understand is what most of the people call in the real world enterprise value is technically what Modigliani Miller would call the operating value of the firm. It's enterprise value minus cash. Net debt plus equity is another way of saying that. So the thing is, if you kind of look at our Modigliani Miller model, 2 differences. One, we would only subtract excess cash. We differentiate between operating cash and excess cash. In the real world, people don't make that distinction. And 2, in the real world, Bloomberg and most people ignore the rest of the non-operating assets. We don't think that that's a good idea in Modigliani Miller and McKinsey view, but the rest of the world takes that shortcut. So I'm not going to say it's good or bad, it's just what they do. So how do I turn the enterprise value model that we're using here, the more academic one, to the real world equivalent? Take my cell E19 equals D19, and then I subtract all of the cash. That's the way Bloomberg is doing it. So then I go back to my balance sheet. My current year cash is column G. So I subtract my operating cash, which is G4, and I subtract my excess cash, which is G5. So basically, this is how Bloomberg calculates enterprise value. This is how Modigliani Miller does. But here's the point. Now what I can do is for my enterprise value for Walmart for the second forward year in column D1 in this new tab that I just add the EV to sales ratio for the second forward year. So D1 equals from the DCF, this new Bloomberg enterprise value, E19, divided by, from the income tab, second forward year, 1, 2, 2023 sales, I3. EV to EBITDA equals What is the enterprise value? Here, 435, divided by income tab I3, 2000 second year, forward year revenue. Sorry. I want to divide it by EBITDA equals Bloomberg enterprise value to EBITDA is the second multiple. Second forward year EBITDA, I8. EV to EBIT equals enterprise value off the DCF is Bloomberg enterprise value divided by income I10, which is operating income, which is EBIT. And then price to earnings multiple equals price per share divided by earnings per share. Well, if I take out shares, the price per share is the common equity value, which is D26, divided by income, second forward year earnings, 1, 2, net income is I22. These aren't dollars. These are just two decimal places. But here's the point. These are the multiples that our model is creating at our current share price. These are the multiples Walmart's actually trading at. And this is the universe of retail companies basically today. Right? Now, this number's a little bit off from a multiple than our multiples because when we did our model, the share price of Walmart was 136. Today, the share price of Walmart is 139.80. Right? So the multiple on 139.80 is a little higher than the multiple on 136. So there's a slight difference because of timing in these values. Right? Because this is based on what I did last week, and this is based on a week later. Okay? So ideally, you want to do this at the same time. Okay? The process that we just did to get the multiples at the same time you're doing your valuation, because you want your multiples to be based on the current share price, not a share price a week apart. Right? But for purposes of what we're doing tonight, we're close enough. I'm going to pause. Does everybody understand what I just did? Because I'm about to show you why I just did this. All right. So I now have my as is. I now have my multiples. I'm ready to do my bull and my bear. So file, save as. Excel file number 2. This is my bull. The point of a bull is this is my optimistic scenario. This is not what I think is going to happen in 12 months. This is how good I think it could be if everything kind of goes right in the next 12 months for Walmart. So what is my optimistic scenario? This is the top, the peak. Well, I'll go back to my model. These are the key assumptions: growth, EBITDA, tax rate. Right? So assumption number 1, the plan that Biden has to increase taxes does not occur. Taxes remain lower for corporations going forward. So assumption number 1 is I don't change the tax rate. Assumption number 2, that Walmart's EBITDA margins get a little bit better. Instead of 6.6%, 6.3%, it goes to 6.6%. They do a little bit better in e-commerce, and as a result of their better in e-commerce, they get a little bit better margin long term. And because they're doing better in e-commerce, Walmart is going to start growing a little faster in the out years. So instead of growing at 3.2%, they grow at 4.5% per year. That's now raising the share price to 150. I also believe that because they're doing well in e-commerce, that their G is going to be 2% a year, not 1.4% a year. Because again, they have better growth opportunities because they're doing better. Now the question is, that leads to a share price of 167.66, making those changes. I'll leave everything else alone. My question is that a reasonable number for a bull case scenario, given those assumptions? Because I might believe my assumptions, but mathematically, is that a reasonable valuation? So here's our sanity check. I go to the multiples. These are the trading multiples of the $167.66 share price. Looking at what the world is paying now for the different retailers, would somebody pay these multiples for Walmart in the next 12 months? Well, it's still in the range. It's slightly below average here. It's right above average here, right above average here, right above average here, below Costco. I'm not saying they will, but they could. So this is a valuation Walmart could actually achieve in a year if they were to get these scenarios. Versus, what if I did this and I'm drinking the Kool-Aid and I said, oh, I think Walmart's going to grow at 4% a year. And I convinced myself that they're going to grow at 4% a year, not 2% a year into perpetuity. I changed my G to 4. Those are the multiples that Walmart would trade at with a 4% G. Do you think that's possible? Is that likely? Does that look reasonable that you're a fund manager and suddenly you're going to pay PE of almost 60 for Walmart? You're going to pay 1.84 times their sales next year? Like, nobody in the industry is really trading at that except for Dollarama. And no one's trading at these high multiples. By the way, that would have been a share price of $351 a share. But that's the point. Like, we give these models and we don't realize that these DCFs are multiplicative. And suddenly you throw numbers that lead to $1 trillion valuation. You're like, oh, this seems reasonable to me. And then you do the math. You're like, well, this doesn't seem quite as reasonable. So that's what I call the sanity check. I need something to rein me in so that I don't get too optimistic or too pessimistic about the ranges that I am trying to create. All right, questions about what I just did? So I'm going to go back to 2%. And I'm going to say my bull scenario says 167 at the top end of my range for the next 12 months. And then for the reasons I just gave you, save. Now I'm going to go back to my as is. And my as is was the current share price, which if you remember, was around 136. So now what I'm going to do is I'm going to put on my pessimistic hat. So this is my bear scenario. So now the question is, how low can Walmart go if things start to go awry in the next 12 months? What's a reasonable bad case scenario for Walmart? What's the downside, right? So I got the upside. Now I got to figure out what the downside risk is. So again, what's the downside risk? Downside risk is Walmart's margins go back to where they were pre-pandemic, around 6% EBITDA. Tougher marketplace. Second assumption I'm going to make is Walmart's growth gets far more tepid, that the e-commerce business challenges them, not helps them. And there's more competition for e-tailing, and that becomes much more competitive. Amazon remains dominant, and we get more global competition for e-tails. I also think that that could slow down Walmart's long-term growth and that their G falls closer to 1%. Right? And global taxes are raised, and so the tax rate next year goes from 25 to 28. Right? Democrats pass it, 28% tax rate. That drives my share price down to 107. I look at my multiples. Could they go this low? Well, I mean, they technically go to 0, but here's the point. What's 0.63 for sales? Now they're a broken company. They look more like a BJ's or a Big Lots, right? And basically, is it possible that they could trade at that level? Yeah, but now I'm starting to get the low end of the range. So they'd have to really things go awry to get down to this level, but maybe I'm starting to establish a floor. Versus, let's say that I put a G down here at 0, and then I got my share price down to 95, and then I see, well, I don't think in the next year Walmart's going to get that low in terms of multiples relative to the rest of the industry. So again, I think 0 is probably a little too low in terms of where the market's realistically thinking Walmart might end up, but maybe a 1% G. And so again, there's a little bit more art to science than this, but this is the idea of establishing the range. So on the high end of the range, I have my bull, and in my bull, I have 167. On the low end of the range, I have my bear, and my bear is 107. and change. So I've established my range, and now I'm ready to do model number 4, which is my target. My target, where do I think on the range I'm going to end up? Okay. And by the way, the last one is just your opinion. Like, and we could have differences of opinion. Some people could be more positive, some people could be more negative, but this would be our opinion of Walmart. Where do we think Walmart is going to end up? So in this case, where does Walmart end up? Well, let's assume that they end up, and again, I usually like to start with my as is for that. So I'll go back to my as is, file, save as, target. I actually think that Walmart's going to probably end up closer to the bull end of the range. Growth will be a little bit higher. Margins will be a little bit stronger, 6.5. And the G's will be better, though not as good. Instead of 2%, it might be like 1.7%. Because I actually do think that they will benefit from e-commerce, and they are in strong competitive advantage with their position. And that puts them at a share price of 151. Now, I've already established the sanity check with my bull and my bear. And so if I think either the bull and the bear are reasonable, then by definition, this is going to be reasonable too. And it's just a question of where in the range do I think they're going to be. So I think 157. So the final step is my buy, sell, hold opinion. If I'm within 10% of the current share price, and the current share price was 130, what was it? 136. And my target is 151. 10% is, call that 14. 14 and 136 is 150. I'm above 150. I'm now in the buy range. Plus or minus 10% is considered a hold. So at a 151 share price, I'm actually the low end, but I'm in the buy. So buy Walmart. That would be my recommendation. I'm going to pause. It was a long diatribe there. Questions, comments, following me, concerns? Yep, Charles?
Yes, I was wondering the true EV for the McKinsey style versus the operating costs. Is there any edge? Like, I mean, we see it as like some small differences in the ratios, but is there an edge that's being considered there, or is it more theoretical?
You mean the enterprise value differences that we're talking about?
Mm-hmm.
The way I like to think about this, and I'm just feeling that I'm old now. So I went to Wharton back in the late 80s, and that's what makes me feel old. And the reason I say that is because back in the late 80s, I remember that my professors for finance came from Chicago, and we had like some of the first editions of textbooks. Like we had first edition Braley and Myers, we had first edition Ross and Westerfield. Like they were literally just being written. And these were the people that left Chicago and went to all the top schools. And the next thing they did is they went to New York. And the point was Michael Bloomberg started his company in the mid 1980s. And the whole point of the Bloomberg data service, there's a point to the story, is that he went to all the Wall Street firms. He said, look, let's agree on common formulas in this common trading platform, and I'll do it for you so you don't have to all do it independently. So when these formulas were built, it was a simpler time. Like there weren't a lot of non-operating assets. They just didn't exist. Like the non-operating asset really was cash, right? And a lot of people didn't keep like $200 billion of cash on hand like Apple. That was unheard of back in the 1980s. Nobody had that much cash on hand. Even banks didn't have that much cash. So there wasn't a lot of excess cash lying around. We didn't have these idea of joint ventures with the whole world, the technology companies like that. Goodwill wasn't as explosive as it was today in terms of acquisitions. Balance sheets were really simple. So when they were doing their initial formulas, basically cash was the operating asset, the non-operating asset. They didn't really have a lot of non-operating things. Value and intellectual property, it really wasn't a big industry back then. So the original formulas never accounted for it. And what I'm telling you, these formulas have lived on for 40 years. Nobody's changed them since the 80s. So the world has changed, but the formulas haven't. And so there's actually, you want to use the word edge, there's edge that can be made by traders who are now looking at the formulas and saying the formulas are kind of missing things. And you're kind of seeing that even here. Like if I look at a company, if Walmart were to have a bunch of non-operating value, it wouldn't be picked up by a traditional equation. I had to find a way to put it into equity value, common value, because it's not in the non-operating category. And so just increasingly you see a little bit of a disconnect. That's why companies like McKinsey come around with this approach. And when they start talking to companies, it makes more sense because they can actually show you the different buckets of value for your business, which the original formulas were never set up to do. Long explanation to your question, but that's one of the reasons why there's a difference between the two. So we're just trying to sync up, because unfortunately, this is what the world uses as their shortcut. So we got to live in the real world as well. Other questions, comments? All right. Now, this is the important part once you get here. We've done Walmart. We've gone through those models. Now, how do I reuse this model to do company number 2? And company number 2 that we're going to do is Nike. Okay. So how do I do a Nike valuation with these files? So let me go back to my as is file for Walmart. Close out all these that I've been working on. And then I'm going to, from that file, open my as is. What I'm going to do is I'm going to file save as, and I'm going to call this Nike. This is my Nike as is. And I'm going to save that. So at this point, the only thing that's changed is the name. It used to be called Walmart. Now it's called Nike, right? And so what I'm going to do is I need to update the Nike data. So the question is, how do I do this? The key to the reusable model is the model data tab, right? And the model data tab basically has 6 years of historical data for a company. In this case, it's Walmart, right? And what I need to do is I need to replace this with 6 years of historical data for Nike, right? So unfortunately, this next step is going to take you 15 to 20 minutes. You won't be able to do it right now. You're just going to have to do this as part of your next homework assignment, all right? But this is how you will use it as a reusable model. You have to go to Bloomberg, and you have to go to FA. So we're going to go to Nike, US Equity, and then we're going to go to the FA section. In the FA section, you're going to go to Custom. Now let me show you what you're going to do, and then we'll come back and tell you how to do it. You're going to have a custom template, which I call model, that looks like this. This template, when you export it to Excel, is this sheet in Excel. So basically, we have 6 historical years of data from Bloomberg that we export from Bloomberg to basically overwrite the data that's in here in Excel. Okay? And what I found, this is the bad news, is that Bloomberg doesn't have standardized templates. So unfortunately, there is no standardized income statement and balance sheet that we can use consistently from Bloomberg that works for every company. So what I had to do in this model was create my own standardized income statement and balance sheet. In order to do that, I needed all the raw materials, all of these files, data fields in Bloomberg create our standardized income statements and balance sheets. But that means for you that I need all of these fields from Bloomberg in this order for 6 historical years. So what matters in your recipe are column A and column B of your model data tab. Column A in Bloomberg is the friendly name, revenue. Column B is the database field name, sales underscore rev underscore turn. In the Bloomberg data service, column B can never change. It's sacred because that's what everybody on Wall Street syncs up to in their data export feeds. Column A can change because that's the friendly name. And I'll give you an example. In the US, we call revenue revenue. In Europe, they call revenue turnover. So if I look at a European company in Bloomberg, it might say turnover, but it's still referring to the same cell, sales underscore rev underscore turn. Okay? So just kind of a technical thing. So here's the point. This is your exercise. I need to recreate this template in this order, and column B is your master. So here's how you do it. When you're in Bloomberg, you go to FA on the company, you go to custom, you create the custom template where it says field here. Easiest way to do this, take column B, for example, B3 is revenue, copy it, go to Bloomberg where it says enter field, paste it, the very first item, select it, that's revenue. Hover over it. Sales, rev, turn, Excel field ID. Do this again. Field number 2 is cost of revenue. There's the database field. Copy B7, go to Bloomberg, enter field, paste, cost of revenue, select. Item number 3, gross profit. Copy, paste, select the first one, done. Repeat 82 times. It's something you gotta do once. It's kind of annoying. You just have to recreate this. And every now and then, I don't know why, there's a little quirk in Bloomberg. My undergrads just told it to me. You're gonna run across one of these, row 27, cash and short-term equivalents. You get down to this one, you copy and paste it, you put it in, and Bloomberg can't find it. You're like, what the hell? And so what I told my undergrads to do is, okay, go to the friendly name, copy, paste, and there it is. You select it, and it's actually the field that we were looking up that Bloomberg couldn't find. So there's some quirks in their database. Don't know why. The fields are there. Sometimes has trouble finding them. Start with column B. If you're missing a column B, search for column A. Make sure you choose the one that's in column B. But basically recreate this. So you get, when you get done, save this as some template. I called mine model. But you need to recreate this. You can change your settings to make sure you're exporting 6 years. Your terminal defaults to 10. The model's only looking for 6. You have to change 10 to 6. And where it says data on the next tab, you don't want any extra columns. So if any of these are checked, which they might be in your default, uncheck them so that all you're exporting are just these numbers. Once you get to this point, you're ready to do your reusable model. Export, Excel, the current template. This will dump this to Excel. Here's another quirk. For whatever reason, Bloomberg just changed this. They no longer allow you under FA, just found this out this past week, to export static data. They only allow you to export dynamic data. So these are formulas. That's why there's no numbers here. Now, on my computer, I have 2 copies of Excel. One copy is my normal Excel, which is what I default to. That's why it's erroring out. The second copy of Excel, file, save as, is the Bloomberg copy of Excel, which has the Bloomberg plugin loaded. Nike data. This is why you have to have the Bloomberg plugin loaded when you go into your cloud-based Bloomberg. So that over here, when you open this up with the Bloomberg version of Excel, and the reason you'll know that it's the Bloomberg version of Excel is because Bloomberg is built into the menu. It's an add-in to Excel. When it opens your file, it's going to actually fill out the data for you. So if you dump it to Excel and you're not logged into the plugin, the Bloomberg with Excel plugin on the cloud, it'll just error out. If you log into the plugin and dumps into that version of Excel, you have the numbers. That's the good news. The bad news is that when you save this file and leave the cloud, it's going to error out again because it can't access the plugin. So the extra step that you have to go through is once you get the data, select the tab, right-click, copy the tab, select the tab, right-click, paste special values. So what that will do is it will basically overwrite every one of these formulas with the actual number. Now, when you save the file, and I'll close out of this and open it up in Excel to show you. Now, when I open up the file in Excel, it doesn't error out. And I can actually leave the cloud. So, sorry to tell you about this step. Unfortunately, Bloomberg made it more difficult, and therefore to do this step because they don't like people getting data from their database. But this is a step that we have to do. There's one other part to this step, but I'm going to show it to you in the model because it'll be easy to see. You then take this data that you've just exported, copy the whole tab, go into Walmart, select your whole tab, right-click, paste special values, and I basically overwrite the Walmart data with the Nike data. So now this is Nike. Again, pausing for questions or comments about this. All right. Then go to my CFI. Make sure my CFI still balances. And then you're going to see errors all over your spreadsheet. And you're like, oh no, why do I have errors over my spreadsheet? This was the step that I kind of mentioned we were skipping. Excel doesn't like dashes. If you have a formula with a dash in it in Excel, this long dash, it chokes Excel and breaks Excel. You can't have long dashes. Now, Bloomberg exports blanks as dashes, and that kills Excel. I haven't found a way to get it to stop exporting blanks as dashes. So unfortunately, the other step you have to do in Excel is take these dashes, copy them, go to find what, paste the long dash, replace it with zeros, replace all the long dashes with zeros. What that will do is it will get rid of your errors, and there are no more errors in your model, and your CFI will balance. Now you're ready to continue on with your Nike valuation. Save. Questions? Yeah, Yenny?
Yes, actually, I have a question, but it's regarding Bloomberg. That is not working for me today for some reason. It's asking me for my email confirmation, and then when I try to put the code, it's really it get off and crashes. Should I call a number or something?
Have you been in Bloomberg before successfully?
Yes, I was doing the search and the screen, everything,
Okay.
but I always like with four
Call their tech
screens.
support. Call their tech support. There's a tech support number on there the Bloomberg number?
They say customer support and
Call customer support,
all
tell
the
them your
countries.
problem. Yeah. There should be one for New York on there.
Okay, I'll come.
Try that. They're open 24/7 and they're pretty good about helping with any technical problems. Because unfortunately, I can't help you with their data service.
Okay, thank you.
Yeah, sorry you're having that trouble. All right. So how do you finish updating Nike? You're going to need essentially 4 screenshots. So I'm going to go ahead and take them now. So all at the same time in Bloomberg. The first one for a company, Nike, US equity, so go there first, is the WACC. We're going to need the WACC. So this is Nike's WAC. So I'm going to take the screenshot of Nike's WAC and save it, which I'll call NKE-WAC. Second screenshot you're going to need is the description, DES, because it's going to have 2 things on it. It's going to have the current shares outstanding, and it's going to have the current share price of the company, which we're going to do our valuation based on. Take screenshot, save. Third screenshot is EEO, because this is going to give us our forecast for revenue and EBITDA, as well as the multiples. File, take screenshot, save. And the final screenshot you're going to need is the Excel RV. I'm going to need, I'll use the analyst curated multiples, custom. I need the multiples that the current share price is based on. Export that to Excel. These are the Nike multiples. Now, just so that if you're trying to follow along and you don't have that model template, I'm going to go ahead and put here into the announcements the Nike data. So this would include the data, the 6 historical years of Nike that I exported right here. So you at least have that for right now without having to worry about going into Bloomberg. So here's the Nike data. Here is insert the multiples. And then here's my 3 screenshots. Here is the EEO. Here is the DES. And here is the WAC. This also serves as your recipe for doing any other company. Insert. Which one? I'm trying to remember which file I've uploaded. DES, EEO. Is it EEO? trouble figuring out why is it doing less of downloads. Sorry, forgot which ones I uploaded. I uploaded the DES, the EEO, oh, the WAC. That's the other one I missed. Insert the WAC. So they have been posted to the announcements. So if you're trying to follow along and you don't have your Bloomberg open, you can at least kind of see what I'm doing with the data that I'm doing it in. So first step, change, copy and paste in the model data tab, get rid of the dashes. Last year for Nike completed was 2020. So go to assumptions, last reported year, 2020. The WAC for Nike is not 5.3%. The WAC for Nike is 9.7%. Update the WAC. The shares outstanding for Nike is not 2,817,000,000. That's off the DES. The share count for Nike is 12.75,275,000,000. The current share price for Nike is not 136.25. It's 136.54. It's actually pretty close. So that's more coincidence. And the next 4 years forecast for revenue and EBITDA are off of the EEO screen. It's these 4 revenues and these 4 EBITDAs. So I need to type them in my model. 43, what's that? 301, 48,600, 52,856, 57,186. And the EBITDAs are 69.44, 84.50, 96.09, and 10.423. And the next 2-year multiples, EV to sales, 4.45 and 4.09. And the EV to EBITs are 29.18 and 22.13. All right, giving me these EBIT margins. So final steps, I go to my ratios. These are my 3 key ratios that I need to forecast. I'll start out with the tax rate. This was Walmart's tax rate. I now need Nike's tax rate. So what is a reasonable tax rate for Nike? Go back to Bloomberg. Number 1, GUID. That's guidance. This is whether or not the company has given us guidance for what they think their tax rate's going to be. Nike last gave tax rate guidance in 2018. They haven't changed it, so I don't have good guidance on the tax rate from the company. Second option, go to BRC. BRC is the research portal that gets you access to the analyst reports. JP Morgan, which we have access to, generally puts a tax rate in all of their analyst reports. So look for a JP Morgan recent report on a company. In this case, March 24th, JP Morgan. Click on it. It'll upload the JP Morgan analyst report. This is their real buy, sell, hold opinion. Search the document, tax rate, enter. And you'll see that JP Morgan's forecasting tax rates for Nike. Going forward, 17.3%. So I'm going to use 17.3% as the go forward tax rate for Nike. Just following on what the JP Morgan analyst did, because they're basically doing the same thing we are. So why not take advantage of that? Secondly, I need an EBITDA margin that is more realistic. How do I come up with that? Well, in my assumptions, these were the two EBIT margins for perpetuities. Now with Walmart, they were in sync. With Nike, they're not. And I have to decide which of these two is probably more realistic for perpetuity, for EBIT margin. 22.13. Make sure I got that right. $24.83. Typed that number in wrong. Either 15.3 or 16.5. Put the wrong EV to EBIT. So which of these two do I think is more realistic? Well, number one, you should always do the EIC first. And if you read through the BICO, you're probably going to be more towards column D. But also, when I looked at the ratios for Nike earlier, this was their EBIT margin last 2 years, 16.3. So I actually think 16.3 and the 16.5 is probably closer to 15.3 in perpetuity. So I'm going to say 16.5 is the perpetuity number. So this needs to be 16.5, not 4.4. It's 4.4 because we got the Walmart EBITDA. So what number makes this 16.5? Add 9 to this, basically 18.4. That makes my EBIT 16.5. And I'll just smooth this out to be 18.3, which is halfway between those two. So I put in a more realistic EBIT margin, EBITDA margin, to get me an EBIT margin. Now I'm left with growth and G for Nike. Save. Before I do, I'll mention one more thing. Invested capital to sales. When you guys did the ROIC tree, this was the invested capital to sales ratio in the ROIC trees. And if we had done an ROIC tree analysis of Nike, we would have seen a big jump in spending between 19 and 20. Because PP&E went up dramatically and working capital went up. We would also see this in the ratios. Because this ratio of invested capital sales went from 25 to 36, same number, because net fixed assets, which is PP&E, went from 12 to 22, and inventory went from 14 to almost 20. So they had a big jump in their balance sheet. Now, in Walmart, we kind of ignored this because they didn't really change their balance sheet. Most companies have similar productivity over a long period of time. Nike does not. Nike actually is making a big investment in 2020. If we had done a CFI analysis, we would see depreciation of 721, CapEx of almost 4 billion. Huge reinvestment rate. So Nike is predicting some growth here in these out years. So two things. One, in my model, I have to decide, is Nike's investment in the balance sheet fundamentally changing? Walmart, I wasn't worried about it. Nike might actually be doing that. So when we set this model up, all of these ratios were a percentage of sales. And I said there were two reasons for doing that. One would be important later. Here's the later. The advantage of putting the balance sheet as a percentage of sales is we don't have to worry about forecasting the balance sheet, because if we forecast growth in sales, it grows the balance sheet automatically, stays in proportion. And cash flow is changing balance sheet. So it's automatically creating the free cash flow gross investment, because the bigger balance sheet translates to automatic gross investment. So the real question is not does the balance sheet grow, does it grow at a different rate than sales? Well, it's starting to. So I have to decide, is Nike fundamentally spending more going forward, or is this kind of a one-time thing and going back? Now, when I read about Nike in their BICO today, it said that they're making a big bet on digital, and they believe that they're going to have half their sales by digital in 2 years, and they're building the platform to do it now as well as an innovation platform. And then they actually think their store footprint's going to go down. You're going to buy less shoes physically, and you're going to buy more of them online. So reading between the lines, I'm actually thinking that Nike, on the one hand, is getting less productive now, but will get slightly more productive later. Translation, I don't think they're going to keep spending 20 cents per dollar on 21 cents per dollar on net fixed assets. I think this number is going to start to come back down, 16% and maybe 14% to where they were. That affects the share price. I also think they might have a little bit less inventory because they're going to be online. And so this invested capital to sales ratio, I think, will be the same or slightly better than what it was historically. So I actually am worried about their balance sheet. Right? I'm still trying to match the share price, but I now have a sense of the balance sheet. Then I need to estimate a G. 1.4%, that was Walmart's G. I need a G for Nike, and I need the out year growth rates. Now, what matters more is not these. What matters more is this. The G is key to your model's valuation. And you can see that in the DCF. Because for any company, the continuing value is most of the value. And this is the formula for continuing value over here. And so G is very important in our model because slight changes in G have big impacts on this continuing value equation because we're doing it into perpetuity and it's multiplicative. So coming up with a realistic G for our model is extraordinarily important. And unfortunately, when we did it in Walmart, we kind of eyeballed it. And that makes me nervous because with Nike, it's much harder to eyeball it. They're a much faster growing company than Walmart. And the difference between a 5% G and a 7% G is a gigantic difference in stock price. So what is a realistic G for Nike? So foreshadowing to the next section of the class in 2 weeks when you do your reading, one of the things you're going to read in the book is in the multiples, you are going to see this formula for EV to EBIT in the multiples. And what you're going to read in the book, back to law of one price, is that multiples are just a rearranged key value driver equation. Every multiple, the price to earnings multiple, the EV to sales multiple, the EV to EBIT multiple, the EV to EBITDA multiple, is just the key value driver formula rearranged. They're all based on the key value driver formula. Matter of fact, DCF is based on the key value driver formula. And it pretty much has to be, because as I said, we have to get to the same answer no matter how we do our valuation. And so one of the things McKinsey shows you is that multiples are just rearranging the math. This is how you get from the key value driver formula that we're using to the enterprise value to EBIT multiple formula. So take a little screenshot of this to remind ourselves of this upcoming formula. I'm going to put this in our model. I'm going to cut and paste this. I'm going to put it here in my assumptions tab just so you can see what we're about to do. So here's the point. I really need to get a realistic G. Well, here's how we're going to do it. Kind of like I did here. I know the EV to EBIT multiple in the real world. It's evidence. I can go look at it today. I have a pretty good idea of the tax rate of what Nike's trading at. We just talked about the tax rate going forward. That's pretty observable and knowable. I know the WACC. It's right there. It's not going to change in our DCF. I have a general idea what their ROIC looks like. High ROICs, once you get really high, we know from key value drivers, high ROIC of 45 or 55 is not going to change the value too much. So I have a pretty good idea of the ROIC. I can back into a G. So using this equation, I can back solve for a G and get a more realistic G. So that's what I'm about to do. In row 20, on the assumptions tab, I'm going to have a model EV to EBIT multiple. And this is going to help me solve for my G. So putting this formula in my model equals, I'm solving for enterprise value to EBIT. Take 1 minus the tax rate. Well, where's my tax rate? It's on the ratios. There's my tax rate, column M, M10. Times 1 minus, continuing on with the formula, the growth over the ROIC. CVG divided by CVROIC. Right paren. Take all of that and divide that by the WACC minus the G. There's my WACC minus my G. Right paren. So basically, my model is calculating a G of 9 point, or with this G of 1.43 is calculating an EV to EBIT multiple of 9.72 with all the assumptions in it currently. And Nike's actually trading at 24.83 times EV to EBIT. So this G does not explain the current share price. What's going to get this closer to 24.83? Well, what if G were 5%? What if G were 7%? What if G were 7's a little higher, 6%, somewhere in the middle, 6.8, getting close, 6.83, 24.83, sorry, 6.8, maybe 6.81. Somebody 6.8, 6.81, basically the same. That's what the market's using, somewhere around this number, to get this multiple, and that's my G. And by the way, that gets me to a share price of 149, which suggests, I bet this is probably closer to 4%, 3%. There's your Nike as is. Then you can back solve for that final year of growth. This is the Nike as is. Share price of 136 and change. Basically, an EBITDA margin somewhere in the low 18s, a tax rate around 17, a balance sheet which spikes a little bit of investment and then goes back to the level it was pre-investment, pre-COVID, and a G of a little under 7%. That's what, if I were to go and look at Wall Street's models, I'm going to see Excel models that look a lot like this. That's Nike at the current share price. Questions?
How can it be expected to grow at nearly 7% in perpetuity and not eventually grow with GDP?
Exactly. So what's actually happening is, kind of draw this. Just think about this. That what's happening to Nike is right now they're in a high growth stage, which is eventually going to mature and eventually decline. And so the problem is I need to represent the growth as well as the mature and decline. So the problem is our G is doing this, right? Because it's representing the higher growth stage and the lower growth stage, it's an average of the two. So you're right, 6.8% is not how fast they can grow into perpetuity, but the next few years they're growing higher than 7%, and that's counterbalancing the years after that that's growing lower than 7% in present value when you average them out at 6.8. That's the challenge with growth companies. That's why these Gs start to come down as you mature. This law of large numbers effect too, but that's also why G is important in your valuation, because it doesn't take much of a change in G to have big changes in share price. But unfortunately, because we're dealing with perpetuity, that's the issue. Ideally, we want to start our continuing value here, not here. We want to start the continuing value when the company is mature. That way, our G is 2 to 3%, and we're not having to forecast a growth phase in our continuing value phase and a maturity phase, right? Problem is, Nike is more than 5 years before they mature in the marketplace, and our model stops in year 5 and does continuing value. So this would be an example where you probably want to forecast maybe 10 years of Nike and then go continuing value, more ideally, or you have to kind of take the shortcut that we did and just say we're going to have to accept a higher G in continuing value to represent that Nike has some more growth before they become mature. But you did bring up a really good issue in valuation. Yanni?
Can you please repeat where did you put the 6.8%? Because I see you put it in the revenue,
I put it in the G. The 6.8% is in the G.
but in the sheet you put it in where? In revenue or where?
The G?
Yeah, the G, the
The
6.8.
The 6.8 I put in the G. Yes, I put this is in the G. And then I went to revenue growth rate, and I just, because these numbers were equaling, I think it was like whatever they weren't 3%, they were different numbers. And then basically I just adjusted it until the share price got within $1. So I cut the revenue growth rate. This revenue growth rate was like 5% or something like that. So I switched it to 3. Because that actually I wanted the share price to be exact. It was a few dollars off.
Okay, thank you.
So I'm saying your last step is to use the revenue to match these. Now, this is my as is. 3 more models to go. Bull, bear, target. This is why it's helpful to do a BICO, to do your EIC. What do we know about Nike? So here's what we know about Nike. Start reading through this. By 2023, because of COVID, they've been moving more online. They're now saying half their sales are going to be in online in 2023, up from their original goal of 30%. Imports to China are important because they make 22% of their shoes in China, 24% of their shoes are made in Indonesia, 50% of their shoes are made in Vietnam, nothing in the US. China and women's clothes are also very important to their future, as well as shorter lead times by improving their supply chain. Scroll through. Nike's increasingly targeting the sub $100 shoe market as an engine of growth. I didn't realize that was considered cheap shoes, but nonetheless, they consider that to be a cheap shoe opportunity for them. They still think they're going to do well in their high-end shoes. They also think the Olympics are going to help them because they're a sports brand. They basically think the digital is going to allow them to dominate and do even more and give them more cross-selling opportunities with all the stuff with like watches and training and Pelotons and everything else. They also believe that it's going to allow for innovations on the shoes. They're going to make their shoes more gamified and use things like virtual reality to help you with fit. They believe that women's market is going to be critical to them. I don't know if you're aware of this, but women's apparel is about twice the size of men's apparel, just in general. So they believe the same is going to play out in athleisure and shoes, and that the real growth opportunity going forward is on the women's side of the business. They also believe that tennis is one of the keys to get there, and so they're going to spend a lot of money boasting on women's sales, endorsements, which are increasingly female endorsements, and just kind of summarizing if you'd read through this, they also are going to do something called Express Lane, which will allow them to innovate their products faster and bring them to the market faster, as well as use RFID to have low inventory. That's what they're telling the analysts. And I say that's important because as we do our bull and our bear, it will affect our view of our bull and our bear. So for example, file, save as. I'm going to do the bull for Nike. What would my bull look like? Well, my bull looks like taxes don't go up. Margins get a little bit better. Maybe 18.4 becomes 18.6 because they're doing a little bit better with both women, China, and digital, especially cost. That the out-year growth rates are closer to 7%, not 3%. And that their G is not 6.8, it's closer to 7.5 because they're actually going to have a longer period of growth before they become mature. That leads to a share price of 188. And as I sanity check my multiples, I need to make sure that I put the Nike multiples in here. I skipped one last step. So NKE, RV, custom, multiples, export, Excel. I need to put the Nike multiples into this model and edit, paste special values, and get rid of the retail multiples to do my sanity check. So at this share price, is this multiple reasonable? I'm probably getting a little bit beyond the range. So maybe, I don't know, 7.3. So on my high end, I'm starting to get comfortable here. In the interest of time, I'll save this. 174 is my bull. Save. I'll just do it from the same file. Then I do my bear. What is reasonable for my bear? The bear side, the discount shoe market turns into a fiasco. It dilutes their brand. It causes them to have to discount. They actually cannibalize their high-end shoe business, and the high-end shoe business doesn't grow nearly as fast, 1%. Margins actually fall because they get more volume at lower price, and their margins look more like they did pre-pandemic at a 16% EBITDA versus 18%. And their G falls to 5%, and their taxes go higher to 21% because the Democrats are successful at raising corporate taxes. That's a share price of 73. These are the multiples at 73. This looks a little too bearish. So I've gotten too aggressive on the downside. So this is going to be more like 6.5, which gets me down to a share price of 97. Still pretty bearish, but I'm near the end of the range where Puma's trading at and Under Armour's trading at. I'm okay with this bear. Got my bull, got my bear. Now I'm ready to do target. Where do I think they fit in the range? Create my model. But you'll notice that when I'm doing this, I'm listing assumptions. I'm listing assumptions that exist in the real world. So I'm not just trying to solve mathematically for an equation. I'm giving you a rationale for why I'm using the numbers I'm using. So as I go from model to model, why am I using the revenue growth rate? Why am I using the G? Why am I changing the tax rate or not changing the tax rate? Why am I changing the EBITDA or not changing the EBITDA? That is the write-up that you're going to have to do for your next assignment. And that is, for your group project, what you're going to have to explain when you go through your PowerPoint. Everything on here tonight was recorded. This turned into a little bit more mechanics, but I wanted to get it all done so that you could do your next assignment, which is a pivot. So here is your assignment for week 5. I'm going to update it in the model. So given everything I gave you tonight, and I'll put these files up here for Nike. So all the files will be here, including the ones that I just did. The one thing that's not going to be here is this model template that you have to create for multiples. And in FA, you have to create yourself the export model custom here to be able to re-export the data. You're going to have to do this. There's no way around getting around doing this. right? So your assignment for next week is Starbucks, right? I was reading this morning that apparently there's an oat milk shortage. That a month ago they started offering oat milk lattes, and they were so popular that oat milk is now sold out throughout the whole company. They can't get any oat milk anywhere, and their customers are pissed off because they were excited about the oat milk. They bought so much oat milk they ran out of oat milk, and they have an oat milk shortage. So, anyways, we're going to value Starbucks, right? And oat milk and their shortage will probably be part of your conversation. So I want you to do an as is. I want you to do a bull, a bear, and a target for Starbucks. And I want you to do a write-up that explains across those 4 models what assumptions you used, key assumptions, growth, EBITDA, tax rate, etc., any balance sheet changes, and why you changed them or didn't change them across your 4 models. That's what you're turning in for next week. And next week, we're going to talk about Starbucks. Okay? And then set up multiples. But basically, that's your next assignment, reusing the valuation model. And this is a good dry run for your group projects. So if your teams also want to meet and use these models to practice with your group project, you can start getting the data and putting your group projects together. Okay? Individual Starbucks, you guys have your team assignments for group projects with companies, but this is the model. And as I said, to help you guys, I'm going to post these final models that I just did here for Nike online, so you have those as reference. Questions?
For when real analysts do these kind of valuations, do they start from the consensus revenue estimates, or do they build their own revenue forecasts?
They usually skip this step. Very few people do this step. This is kind of a Joe step. People go right to the next step. They go right to the target, they go right to the bull and the bear. They don't do the
But I mean, but do they build their own revenue model for the company, or do they look at other forecasts?
Yes and yes. I mean,
Okay.
you're going to still keep an eyeball to make sure that you know your peers, like, what are they doing? But a good analyst will build their own revenue model. But a bad analyst, you could get along on Wall Street for a few years just copying everybody else. Seriously. And I know stories where there are analysts that have actually done that. Right? They're not very good analysts, but hey, just follow the crowd. Just change your numbers a little bit. Right? But people start to figure that out, that if you're really a good analyst or not. But generally the ones build their models. And you can kind of see that here in even the MODL is where Bloomberg is trying to standardize the models, MODL, because each of the analysts, when they upload it, it's now increasingly visible to the rest of the world, the standardization of what they're forecasting. So they're forecasting in a standard way, but I still have to forecast. And they forecast a little more granularly than we do, because they're going to forecast by region, by product, right? Where we're just forecasting very top line, overall simplistically. But we don't have the data access that they do to be able to do that. Good question. Other questions? All right. By the way, you are exactly where my undergraduate class was today. My undergraduates are doing the exact same assignment that you are doing. Theirs is just due on Monday. Yours are due next Wednesday. The reason that's relevant is the next 2 days, my TAs have office hours with these exact files, doing this exact assignment on Starbucks. So if anybody wants to visit their office hours over the next couple days, you can see them, and you can get their help as well in doing this. So I want to make sure you guys are available and know that they're working on the same assignment. The TAs have the same files that you have, and everybody's doing Starbucks at the same time. So this actually worked out well for being in sync to do the assignment. I will change what says your next week's assignment is to be this. So make sure you don't do the wrong assignment by mistake. This video I'll post as soon as it processes on YouTube. So you'll have the access to this video of what we've recorded tonight. And otherwise, have a good night. and I'll see you guys next week. And we'll be talking a lot about Starbucks. So it'll be your turn to show me your models and what you think about Starbucks. Have a good night.
Thanks. Have a good night.
Good night.
Thank you.
Bye.
Hey,
Professor, were you going to post this like a standard set of screenshots for Starbucks, or
No, that
were
you
we
gotta
supposed
get
to do our own?
You got to get out of Bloomberg. But that's why I gave you the recipe of screenshots, because if you go back and you look at the ones I did for Nike, it's the exact same screenshots. That's why I put
That's
that.
fine. I just didn't want to not match
No, you're
the
gonna
exact
you're
share
gonna have to
price
get
or
the
whatever.
data, and actually your share price may be a little bit different. So for example, let's say Greg, who's still on this call, he does his on Friday and you do yours on Thursday. You're actually going to have two different share prices for your models, and that's going to be okay because it depends on when you do your share price.
Okay.
So you could be a little bit different over the next few days, just because the stock price is changing in real time. That's why the screenshots actually help, because your screenshots lead to one value, his screenshots lead to a slightly different value, and both would be legit for this assignment.
And
Sounds good.
And I think that maybe answers my question. So my valuation model, that I put in,
Mm-hmm.
it was slightly different from the as is Walmart model that we started in class.
Yeah.
'Cause I thought I had to match the video for the turn in.
You did. For the turn in, I wanted everybody to match the video,
Okay.
which was basically Walmart 2 weeks ago,
Right. Okay.
just so that we all had the same file.
Gotcha.
Now I'm turning you loose, and we're not going to all have the same for the companies, because you're going to be doing it at different times. And the same thing, you're now going to also do 3 different group projects, which will all have their unique share
Right.
prices as well.
Okay.
Yeah.
And then lastly, when we're doing the ranges, the bear and the bull and the target,
Mhm.
are we forecasting for the remaining year or all the way out? You know, the 6 years down. Like what is that price? Like when should we expect to see that bear or that bull or that target?
Well, Wall Street standard is a 12-month target. So it gives them a little wiggle room to be wrong as well. Because the idea is, what should the company be trading at in a year? But they're using today's empirical value.
Okay.
So you have value of today to say, okay, the company should eventually trade to its value over the next year. This is the value that is a fair value for the company. Because obviously there could be some short-term supply demand issues.
Right. So day 0 is the day you create the model. It's
Correct.
day 0 plus 12 months out.
But if you look, like right now in Bloomberg, I don't know if you can see my screen on sharing, so let me share back again. Share. Like this is the ANR screen in Bloomberg right now for Nike. And you'll see this is the 12-month share price target. So every one of these share prices that the analysts are putting in is for 1 year from today. This is
Okay.
a 12-month target. So, but it's based on the data we know today that we're forecasting.
Gotcha.
So, but that's what you're putting in. And so you're putting in a 12-month target for the bull, the high end, a 12-month target for the low end. How low could it go in the next 12 months? How high? And then your range is your opportunity for your own opinion, which is what the final target share price would be. And you can see that there's differences even in Nike. Like here's an analyst, Piper Sandler, came out today at 170 versus somebody else that thinks they're at 150. So there's variation even amongst the analysts. There's not a unanimity about what their share price is going to be. There's 136.
Okay.
So you can have a difference of opinion on what those target prices can be.
And then, so looking at Baird, who had the really low price, but his 1 year return, I guess, on his analytical skills is only a 2.67 compared to.
Yeah. So he's not a very good picking analyst right now. so again, you could use that for whatever it's worth. But no, that's what people do. He's not exactly. He doesn't seem to be picking stocks very well. So therefore, I don't know if I'm going to give as much weight to his opinion when he says don't buy Nike.
Right. Okay. Now that makes sense. Now I appreciate that.
Oh, no problem.
And this class was definitely recorded, right? Because this
I'm
was
still recording right now.
this was a good one.
And as soon as it finishes recording, I'm going to pop it up on YouTube. Because yeah,
All
I
right.
threw a lot at you guys, but
Yeah. This was a good one. I earned my money tonight.
all right. I'll see you
Bye,
guys
sir.
next week. Have a good one. Bye.